Hey, welcome back to my channel. Something's unfolding in Ontario that barely made the evening news, but it could reveal one of Canada's biggest economic secrets.
It was a billion-dollar bet.
We're opening the first full-scale commercial electric vehicle plant in Canada.
But less than 3 years on from Justin Trudeau and Doug Ford's commitment to electric vehicles, GM has pulled the plug. The Kami Ingersoll plant in southwestern Ontario, ending production of the BrightDrop electric van.
GM has quietly paused production of its BrightDrop electric vans at the Kami plant in Ingersoll, a facility once celebrated as the symbol of Canada's EV rise. Overnight, more than 1,000 workers were affected. On paper, it looked like the kind of headline that could trigger panic: lost jobs, suspended production, and a potential domino effect across the auto sector. But that's not what happened. Instead of a collapse, Canada's response was almost surgical.
But that's where he's at right now. We have 350 people that are going to be laid off, not mentioning the other, I think 700 or 800 that are already laid off. They breach a contract, we're going to sue them. Simple as that. And he knows that. They breached a contract, and we're going to make sure that we get another vehicle in that area.
Ottawa activated emergency training programs, unions stepped in to protect wages, and regional suppliers shifted focus to domestic projects to keep the chain moving. Within days, operations stabilized, and while U.S. plants made headlines for mass layoffs and uncertainty, Canada quietly held its ground. It makes you wonder, how did a country hit by the same tariffs and the same market downturn has managed to stay standing? What's Canada doing differently that others aren't seeing? Before we dive in, tap that like button. It tells YouTube this content matters.
I never thought for a minute it would ever come to the point where they're almost shutting down, right?
Well, we've had multiple shutdowns here before, but if this is going to be a permanent closure, that's a different story.
General Motors has announced it's ending production of its BrightDrop electric delivery van at Kami.
But the story doesn't end in Ingersoll, because behind that factory shutdown lies a much bigger chain reaction coming straight from Washington. When the Trump administration imposed a 25% tariff on vehicles assembled in Canada, the impact was immediate. Parts got more expensive, logistics slowed, and automakers like GM suddenly faced an uphill climb. Internal estimates suggest the company absorbed around $1.1 billion in tariff costs in the second quarter alone, with total losses projected between $4 and $5 billion for the year. Yet, north of the border, Canada didn't let the system break. Instead of chaos, Ottawa activated targeted relief programs, a combination of tax credits, regional adjustment funds, and emergency supply chain grants designed to keep production stable. Suppliers that once relied on U.S. imports began redirecting operations inward, strengthening local manufacturing and reducing exposure to the American tariff storm. This contrast is striking. While Washington doubled down on protectionism, Ottawa doubled down on stability. And that difference, calm over chaos, might be what's keeping Canada's auto industry alive when others are starting to falter. If you've made it this far, consider subscribing. It's how we keep uncovering what others won't say. And even beyond tariffs, another challenge quietly tested Canada's resilience: its own climate. BrightDrop's pause wasn't just about economics, it was also about physics. Electric vehicles face a unique problem in Canada's brutal winters. According to research by the Canadian Automobile Association, temperatures between 7 degrees Celsius and 15 can cut driving range by 14% to 39%. Around 65% of EV owners across the country report noticeable performance drops during cold months, enough to make early models like BrightDrop struggle to meet delivery targets in northern regions. But rather than seeing the cold as a barrier, Canada turned it into a catalyst for innovation. Across Ontario, at least 4 startups are now developing cold-resistant battery cells designed to operate efficiently in sub-zero conditions. Companies like Purolator and Canada Post have begun transitioning their fleets toward hybrid and hydrogen vehicles, ensuring year-round reliability for logistics and delivery networks. In other words, the same climate that once froze EV performance has become the driving force for new breakthroughs, pushing Canada to adapt faster, smarter, and more sustainably than anyone expected. What truly set Canada apart wasn't just innovation, it was preparation. While other nations scrambled to react, Ottawa had already built what economists now call a shock absorber economy. Instead of waiting for crises to unfold, Canada developed a framework of financial tools designed to protect jobs, stabilize production, and sustain worker confidence through any disruption. Between 2020 and 2024, the country attracted more than $46 billion in EV-related investments, supported by roughly $52.5 billion in public incentives, the largest in the G7 relative to GDP. Behind those numbers lies a carefully layered system, a $5 billion strategic response fund to help companies hit by tariffs, a regional tariff adjustment fund that recently doubled from $450 million to $1 billion to keep regional manufacturing steady, and a $450 million retraining initiative to help 50,000 workers transition into EV and battery supply chain roles. The result isn't just stability, it's trust. Canada's workers see government policy not as distant bureaucracy, but as a safety net that moves with the market. And that confidence, more than any tariff or subsidy, is what keeps its industrial engine running when others stall. Meanwhile, across the border, General Motors' U.S. operations are feeling the full weight of Washington's tariff war. The company has already absorbed $4.5 billion in extra tax-related costs, and reports suggest it's being forced to reinvest another $4 billion just to navigate domestic political barriers and reconfigure its supply chains. For a company once seen as the symbol of American industrial power, this is more than a financial strain. It's a structural setback. Analysts now describe Canada as GM's natural buffer zone, a market where research, engineering, and testing continue without the uncertainty that plagues its U.S. plants. Stable energy prices, predictable policy, and lower logistics costs give Canada a rare advantage in a region otherwise dominated by volatility. Around Ontario, that advantage is multiplying. Projects like Volkswagen's St. Thomas Battery Plant and Stellantis LGES's Windsor facility have created a dense ecosystem of suppliers and skilled labor that GM can still rely on. It's a contrast that couldn't be sharper. While the U.S. grapples with political headwinds and rising costs, Canada is quietly becoming the only place in North America where the EV transition is still moving at full speed. Rather than reacting defensively, Canada has begun to rewrite its entire industrial playbook, quietly but decisively. The BrightDrop pause didn't derail that vision, it clarified it. It reminded policymakers, investors, and manufacturers alike that depending too heavily on U.S. markets is a vulnerability, not a guarantee. In response, Canada is now building a self-contained made-in-Canada EV value chain, one that runs from the mines of the North to the ports of the Atlantic, connecting raw materials, advanced manufacturing, and global exports under a single integrated system. In the mineral-rich regions of northern Ontario and Quebec, a new industrial backbone is emerging. Nickel, lithium, and cobalt, once exported as raw materials, are now being reprocessed and transformed domestically to feed the country's growing EV ecosystem. Ottawa's public investment has surpassed private capital by about 14%, a signal that Canada is playing the long game, not just attracting foreign projects, but locking in local control over strategic resources for decades to come. Ontario, long defined by its role in assembly line production, is undergoing its most profound industrial transformation in a generation. Cities like St. Thomas, Windsor, and Alliston are evolving into centers for battery chemistry, materials science, and component innovation, linking universities, startups, and multinational corporations down in a cooperative model rarely seen elsewhere in North America. Meanwhile, Canada-EU partnerships are quietly reshaping the country's export future. Under new green trade frameworks, Canada is positioning itself to supply carbon-neutral batteries to European markets by 2026, tapping into demand for transparent, low-emission supply chains. This eastward pivot could give Ottawa the industrial leverage it has long lacked, a way to grow without depending solely on the American consumer base. By choosing autonomy over dependency, Canada isn't just insulating itself from the next economic shock, it's reshaping the industrial geography of the continent. If this strategy succeeds, the next chapter of North American manufacturing might not be written in Detroit or Texas, but in Ontario and Quebec. BrightDrop may have stopped, but Canada hasn't. What looked like a crisis became a real-world stress test for the nation's industrial resilience, and the results speak for themselves. In an era defined by volatility and protectionism, Canada has shown what long-term strategy and quiet stability can achieve. While the U.S. wrestles with tariffs, political swings, and production cuts, Canada continues to hold its rhythm, protecting jobs, attracting new investment, and and keeping factories humming. Instead of chasing protection, Ottawa has chosen smart adaptation, a pragmatic balance between shielding workers and staying open to global opportunity. And it's paying off. GM still maintains operations in Canada, signaling not just confidence in one company's future, but in the broader ecosystem that supports it. Economists now describe this as North America's best shock absorption model. It's not about luck, it's about consistency. And in a world where markets can shift overnight, consistency might be the rarest competitive advantage of all. So, as the dust settles, one question lingers. If Canada can stay steady through this kind of turbulence, can North America's supply chain really function without Canada at its center? Thanks for watching. And if this resonated with you, don't forget to like and subscribe. Every click fuels the truth.